We're the first week of January here, and we had a Fed meeting a couple weeks ago, and as predicted, the Fed dropped interest rates by 25 basis points. We kind of thought that might be a good thing, but oh my gosh, Dan, soon after that happened, the bond market was, had a pretty negative reaction. But not only that, my crypto balances went down, my stock portfolio went down. I'm like, how can one man, Jerome Powell, have this impact where every single part of the market went down? Can you add any color to what happened and what this means for us as far as it relates to mortgage rates and how they're going to roll in 2025?
Yeah, it's a good question. And yeah, that Fed meeting was one that really kind of spoiled the party for a lot of the markets out there. So a lot of funny memes with Jerome Powell. But the bottom line is this was a cut. They did a 25 basis point cut at this meeting, but it was very much a hawkish cut, which is really what we expected. So a couple things to unpack here. First of all, there is an indirect relationship with mortgage rates and what the Fed does, but certainly not a direct one. A lot of people are under the assumption that the Fed is cutting mortgage rates, but in fact, they are cutting an ultra short-term rate. It's actually an overnight rate that banks use to lend to one another. It does directly impact certain short-term rates, like your money market accounts, your credit cards, car loans, things like that. But it does not directly impact long-term rates. And a lot of what impacts that is what the Fed's really posturing or projecting out there on inflation and the labor market. Those are going to be your main drivers of mortgage rates. But I think many people were taken by surprise that, hey, the Fed's cut 1% now this year, and we've seen mortgage rates go 1% higher, right? So the Fed, they were fully expected to cut 25 basis points at that December 18th meeting. And like I mentioned, that's 1% of cuts this year. Many people out there were criticizing the Fed because they're like, well, inflation has started to move up a little bit. And it really, not only has it not made progress the last few months, it's actually moved a little bit higher. And the labor market, back on the September 18th meeting, the Fed was concerned with it. That's why they led off with 50 basis points of cuts. We saw the unemployment rate moving higher, looked like there was a big concern there. And remember, the Fed has a dual mandate. So they want to see stable prices, which means they want to see inflation, or they want to see the prices of goods and services rising at 2% per year. And the other part of their mandate is that they want to see maximum employment, which means they don't want to see that unemployment rate go too high. So they look at both. And before, they were really concerned with the inflation one. But then inflation started to moderate and come down. They're pretty confident inflation is going to get to their 2% goal, but the labor market showed some weakness, and then that was their primary concern. If you look at their statement, now they believe that's balanced. In fact, the reason why this was a hawkish 25 basis point cut really all has to do with their projections. So I want to just walk you through a couple slides just to show you what changed and why the market had such a negative impact. So when we look at their statement, right, there's many parts of the Fed meeting. There's the statement, and then this was one of those that had the SEP, or the Summary of Economic Projections. And then, of course, you have the Powell press conference. So the Fed funds rate, they cut by 25 basis points, and it's now in a range of 4.25% to 4.5%, which is 1% lower than it was before they started cutting on September 18th. And the effective Fed funds rate splits the difference. It's 4 3/8. And it was almost unanimous as far as the decision to cut rates, but there was one dissenter, and that's Cleveland Fed President Beth Hammack. And if you look at their statements, you have to look at like almost every word. They were very similar, but they changed some of the context to be slightly more hawkish when they're talking about doing additional adjustments to the Fed funds rate. And one thing I was hoping to hear was that they were going to announce when they may stop their asset runoff of their balance sheet, but there was no mention of it. And, just to kind of unpack that for a second, the Fed, they amassed a massive balance sheet from all of their QE efforts, quantitative easing, where they bought mortgage-backed securities, treasuries, but we're talking like $8-9 trillion they accumulated of these things. And when the Fed was doing all that buying, that absorbed a lot of that supply in the market. They were buying a ridiculous amount, and that kept rates artificially low to help us recover and keep borrowing costs low after COVID. And they also cut the Fed funds rate to zero, of course, for a while at that time. But then the Fed went on a path to normalize things because inflation got to 40 plus year highs. There was all this money in the system from 5.2 trillion in stimulus. So the Fed hiked up to 5.375% from zero. And then they started to reduce that balance sheet. So they were allowing these assets to roll off their balance sheet, but that floods the market with more supply. And they're allowing mortgage-backed securities and treasuries to fall off the balance sheet. But then earlier this year, I believe it was like at the May 1st meeting, they announced we're going to slow down the runoff, which means they're going to put a cap on how much of the assets are going to roll off their balance sheet every single month. And then anything above that cap, they actually reinvest those proceeds back into the treasury market. But I am expecting, because of some liquidity concerns, and they have hinted towards this, that sometime in 2025, they're going to say, we are going to completely stop the balance sheet runoff, which that can actually be helpful for mortgage rates, because anything that's falling off their balance sheet, they're going to keep that balance sheet what's called net neutral, which means any assets maturing or falling off or they receive principal payments, they're going to have to reinvest back into the treasury market, which can absorb some of the supply out there. But bottom line is they didn't mention that at this meeting at all, but I do expect it sometime this year. But the big thing that the markets didn't like is something called their dots plot chart. So this is where the Fed members, all 19 of them, they anonymously plot on this chart where they think the Fed funds rate is going to be. And you could see here 2024, 2025, just 2 months ago and change, right? The September 18th Fed meeting. This is where all the Fed members thought the Fed funds rate was going to be in 2025. And the median projection was 100 basis points of cuts, or 1% of cuts in 2025. 2 months later, it changed pretty drastically. You can see now the median is 50 basis points, which means that the Fed in their projections removed 225 basis point rate cuts from this year. That is something the markets didn't like. I think that a lot of the markets were expecting the Fed to remove maybe one cut, but the fact that they removed two, I think it might have caught the markets a little bit by surprise. And if you look at their projections, they upgraded all aspects of the economy. So if we look at the unemployment rate, initially at that September 18th meeting, they thought the unemployment rate was going to get up to a level of 4.4% in 2024. They downgraded that to 4.2. In 2025, they thought it was going to remain around 4.4, and now they downgraded that to 4.3. So they think the labor market's going to be healthier. But one thing I like to do is look at where all the Fed members think the unemployment rate's going to be. Because while the Fed had a hawkish change here on their projections, it's not going to take a lot for them to flip-flop and change their mind. I mean, just look between these two Fed meetings, how much things changed. The Fed is very quick to change their tune based on the incoming data. If we start to see the unemployment rate go up, forget it. They're going to get way more aggressive on cutting rates, and they're going to be extremely concerned about that. So what might take the Fed by surprise? Well, that's where this chart helps you out. You can see that 14 Fed members do not think in 2025 that the unemployment rate is going to go above 4.3%. Well, right now, the unemployment rate's 4.2%, so it doesn't really give it a lot of room. And if you look at the other 5 Fed members, they don't see it going above 4.5%. So the majority don't see it going above 4.3, and all of them don't see it going above 4.5. So I think if you get an unemployment rate that's in the 4.4, 4.5, 4.6 range, forget it. These Fed members are going to be taken by surprise, and they're going to change their tune quickly. I actually wouldn't be surprised if this happens, because I think there's a lot of underlying weakness in the labor market, which we can get into. And the published data, I think, is kind of like a crock of baloney, to be quite honest with you. And I believe that that will come to fruition this year. We'll get the QCEW data, which shows you the actual job data for 2024. And it's going to show that about half of the jobs that the BLS said happened never actually occurred, because they have all kinds of issues where they're overstating job growth and then revising it lower. So I think that this is something that may play out, but now we at least know what might take the Fed by surprise. And then, of course, they upgraded GDP and inflation. They think inflation in 2025 on the headline PCE, not going to be 2.1 like they thought previously. It's going to be 2.5. And the core PCE, which is the most important, that's the one the Fed wants to see at 2%. Initially, they thought it was going to be 2.2%, getting close to that target this year. Well, now they think that's not going to happen. It's going to be 2.5%. And in fact, we might not get, based on their projections, to 2% until 2026 or maybe even 2027. So you put all that together, and that is why the bond market didn't like it, because of that hawkish switch. And the asset prices out there, like risk-on assets, like stocks, you look at crypto, they didn't like it either because, listen, when you look at assets, there is a direct correlation to liquidity, right? Global liquidity and asset prices. If you just look like a global liquidity cycle and you look at stocks or you look at crypto, it lines up pretty amazingly because, listen, when the Fed cuts, they are removing restriction from the economy. Borrowing rates on certain things are directly impacted and they're lower. It causes more liquidity out there, which always finds its way into assets. So that's a big part of the reason why. But also, I mean, listen, the stock market setting all-time high after all-time high, I think looking for an excuse to kind of correct a little bit, and the same thing with the crypto market. I mean, Bitcoin was up to 108,000, and since its breakout from its reaccumulation zone, really hasn't had any correction at all. It's been pretty straight up. It is so normal in a bull market to see not 10% corrections, like 30% corrections before moving higher. And I think both stocks and crypto were due. I mean, remember, they've been on this euphoric ride, thanks a lot in part because you have President-elect Trump, who is much more pro-business, going to deregulate. And of course, he's the first pro-Bitcoin, pro-crypto president. And he got rid of Gary Gensler, the SEC chair that was awful for crypto, and replaced him with somebody that's pro-crypto. And of course, he's talked about starting a strategic Bitcoin reserve where potentially you could have in Q1, I mean, you could have the United States buying 1 million Bitcoin and sitting on it for 20 years. That's like 5% of the entire supply of Bitcoin. I mean, could you imagine how bullish that would be for the crypto markets?
Yeah, well, I'm looking forward to talking a little bit more about Bitcoin. I just want to stay on the Fed thing for a second because I agree with you in that it wouldn't take much for the Fed to change their tune quickly. I feel like they came out of the gates. What was that? Whatever the pivot meeting was. I don't know if it was September or the one before that.
September 18th.
Yeah, and everyone got super excited, and they were talking about all these cuts, and it was almost like this exuberance, like was quick to build up about how exciting it was going to be and how much the Fed were going to cut and so on and so forth, and it's almost like they're trying to walk that back a little bit, like a little bit of a wet blanket on it, like to chill things down a little bit. But to your point, all it takes is these unemployment numbers to come out different. It takes, a couple misses or some lower numbers on the PCE. And all of a sudden, I think they would change their tune pretty quickly. They just don't want people to be too optimistic. But for those of us in the mortgage business, it was like a freaking dagger in the heart, when we saw what happened with the market. We saw the quarter and we had, a 50 basis point sell-off, after that.
That day alone.
Price. Yeah, that day alone.